I am going to take the liberty and get this thing started. We keep these to 30 to 45 minutes, folks. We will share this content after the fact. A couple housekeeping items. First of all, I'm Andrew Rosen, President of Diversified. We have Mike Horwath, who is our Chief Investment Officer, the man, the myth, the legend. You've seen a lot of his communications through the weeks and years and months. I encourage you to read it, especially his quarterly newsletter, which should come out today or tomorrow. I get a sneak peek, some of the perks of being me, I guess. And it's awesome. So give it a read. I highly suggest it. And great work, Mike. So today, format is Mike's going to educate us all. If you have questions, write them in. We'll save some time at the end for any questions that you may have. So don't be shy. They're all written. I'll proctor it. And besides that, Mike, wow us, would you?
It's always hard. It's hard to impress you. Welcome, everybody. For those who don't know me, my name is Mike Horwath. I am the Chief Investment Officer here at Diversified. So every quarter we get together. I usually do two things on a quarterly basis. We do this webinar designed to be a more kind of a verbal version of my newsletter, which is written, but they're both designed to be an overview of what's going on in markets. So what's going on in markets, the economy, anything that we're finding pertinent or relevant. These are the opportunities we have to kind of share that with you. And as Andrew said, the newsletter should go out here today or tomorrow. And later this month, the recording of this will go out. So looking forward to getting all these pieces of information out to everybody. But this is our Q1 recap, as we propel ourselves into Q2. What are the major highlights from an economic and market standpoint? I think, one, growth is now really the focus. People may not expect that given what's happened the past few days and really what's been the narrative the past few days. I think the conversation has naturally been about inflation. And inflation's been the focus of everything. The inflation scenario has been the focus since kind of mid-2022, really into 2023. And really what we need to focus on now is I think the Fed has done enough to get inflation down. Now we're going to talk about it in more detail, but growth is now going to be the primary focus. And why is that? The last leg of inflation is really the hardest. And we'll look through some graphics, but we know this last leg of inflation to get from 3 to 2% is going to be the longest. It's going to be the bumpiest. It's not going to be a straight line. But the reason why the Fed has been able to be pretty methodical and slow to start cutting rates, and that's what people are starting to come to grips with, is that growth is strong. And that's a good thing. Growth from an economic standpoint has been strong. Ever since July of last year, the Fed has paused raising interest rates. We think they're likely done, barring some way unforeseen scenario from an inflationary perspective. The Fed wants to be done raising rates. They paused in July. They got up to about 5.25. So they went from the floor of 0 up to about 5.25 on the Fed funds rate. We all see it in both the borrowers market and the savers market, right? If you want to go buy a house, it's a little more expensive than it was. But if you also have money in money markets, you're making more money than you have in a long time, right? There's two sides of the coin. But like I said, corporate fundamentals have been really strong. Economic growth has been really strong. Those components are giving the Fed the ability to be patient. And I think that's an important perspective to keep. Earnings continue to be strong. We saw resilience in Q4. Expectations for Q1 are still pretty strong. And I think when you zoom out and you look at the earnings picture, it looks pretty good for 2024, 2025. We're looking at nearly at least high single-digit year-over-year earnings growth in each of the next 2 years, including 2024 here. So 2024 and 2025. Companies are making money. Economic growth is still positive. We've become pretty constructive on this idea of either a soft landing or a no landing. And we can talk about that a little bit here shortly. But the idea that recession is unlikely, and even if it does kind of rear its head, it should be very shallow, very, very quick to occur. On the right-hand side, I always like to show kind of the best real-time data on the GDP side that we have. the Atlanta Fed does is what they call the GDP Now tracker, and it's essentially like their real-time analysis of what the current quarter growth perspective looks like. And you can see the green line shows they're up and down a little bit, but if you look on the left-hand side, the scale, we're not trending down below really 2% right now. We're looking at 2.5 to 3% on quarterly, and it becomes January or annualized GDP growth for Q1. Still strong growth. If we think about growth, it's trended around 2% over the course of a long period of time, and we're certainly a little bit above that, which is great from an economic standpoint. From an asset class perspective, I think markets have kind of in line with that. They've rallied, especially the equity side. We see on a year-to-date basis, global stocks up a little over 8%. U.S. large cap continues to drive predominantly those returns, up about 10.5%. And you see some of the other areas, small cap and international, which we'll talk about a little bit later, trending a little bit closer to 5%. This is through the end of the quarter. We'll also kind of dive into why are bonds a little bit negative to start the year. We'd spent all of 2023 talking about a bounce back in bonds, and candidly, it took until November to start to see that happen. And I think what happened in November and December within the bond market is a primary reason for why we're off to a little bit of a slow start here in 2024. But our perspective and view on it on a forward-looking basis has not changed. But equity markets up about 8% through the end of the quarter. Fixed income was down just under 1% through the first quarter so far this year. This has been the primary conversation over the course of the last couple of years. Almost every conversation I've had from an economic angle has been around inflation, the Fed, and interest rates. That's all we, it's kind of like Groundhog's Day. It's what we constantly talking about it. Look, the Fed wants to be done, and they've indicated that they're done raising rates, barring anything unforeseen happening. The big reason why is what we're about to go into, and that inflation has come down. It's no longer 5, 6, 7% on an annualized basis. We're getting closer to target. And you could see rates have really peaked. We're on a Fed fund, we're between 5.25 and 5.5. And whether you look at what the market's pricing in, which is the green line, the blue line with the diamonds is what the Fed is telling you they want to do. And the purple is their long-term ideal short-term interest rate, all of which show the trend is down. It's a matter of when. And I think everybody, and the market's reacting to these short-term narratives of, are rates going to get cut in June, July? Is it going to happen later in 24? Is it going to get pushed to 2025? And I think largely my point is, don't get caught in that minutia too much. Because at the end of the day, as long as rates have peaked and we're going to start trending down over the course of the next 2 to 3 years, the magnitude of when that starts, it's less relevant, right? A 6-month difference of when we start is not that big of a deal. The bigger point is that we've peaked and that our trend is in the downward direction. So I think that's an important thing for interest rates moving forward. And I think this is an important graphic to understand what's happened over the course of the last, call it 6 months. Because if we sat here at the end of October, bond markets were negative 2%. And I had been sitting there saying, hey, look, they look pretty good on a forward-looking basis. The problem is that for the first 10 months of 2023, markets were concerned about where the Fed would go. And what we saw was November and December, markets really start to price in pretty much 6 cuts. The red line is what was priced in by the end of last year. They got a little bit ahead of themselves. So they started to say, look, the Fed's going to be really aggressive cutting rates. They got a little bit ahead of themselves. They went from this really almost the Fed's not going to cut much at all stance at the end of October to now they're going to cut 6 times. The Fed was telling you they're going to try to cut 3 times. It's not a perfect science, but they're telling you one thing, the market was pricing in 6. So we ended the year up over 5% on the bond market in 2023. I think markets got a little bit ahead of themselves, not drastically. So what did we see for the first quarter? We saw the markets go from pricing in the red line to the green line. The trend's up, which really just looks more in line with what the Fed's telling you. The market kind of went from, hey, we're pricing in 6 rate cuts to closer to 3, which is what the Fed had been telling us for the past several months at that point in time. We think that's a more healthy place to be. We think that makes sense. And naturally, it's what the Fed's telling you. So for the first 3 months of the year, we saw bonds pull back a little bit as markets went from this red line up to the green line, but that's really what's happened in the interest rate world. The key right now is, where does growth go? Because if growth can continue to remain strong, it buys us more time. What you don't want is the Fed to have to cut rates very quickly because growth plummets, earnings plummet, because that's not the ideal scenario. We want them to methodically drop rates because the economy is strong, maybe unemployment starts to weaken a little bit because inflation gets down to target. So up to this point, the good news is that growth remains pretty strong. We're seeing the consumer, 70% of GDP growth here in the US, remain pretty strong. You see household balance sheets as big as they've ever been. You know, the average net worth of an individual here in the US is as high as it's ever been. And like I said, you're seeing spending remain pretty strong. You're seeing earnings remain pretty strong. All of these economic components have at least given the Fed time to allow inflation to continue trending downward. What progress has been made, though, on the inflation front? The past few days, it's felt like we're going back into an inflationary environment. These types of blips are going to happen. If anybody expected that the drop in inflation to be this perfect line, I think you just had bad expectations. It's going to be bumpy because there's too many components, there's too many variables to inflation that it's not going to be perfect. But the good news is, if you look at the trend of both CPI, right, the Consumer Price Index, or the PCE, which is the purple line, that's the Personal Consumption Expenditures Index, both of which are inflationary indexes that the Fed uses, what you see is the downward trajectory. Inflation has peaked. The hardest part, though, is getting from those data points to the red line, which is the 2% target. 2% is just a number that the Fed throws out there. It's what they've liked. There's really no basis for it other than it's low positive inflation, which is what they want to target. But if inflation can get down to 2.5, it doesn't mean that the Fed's unhappy at that level. What the Fed does not want to see is an acceleration in inflation. They don't want to see core CPI above 6% on a year-over-year basis. That is a problem. But low positive inflation is not a problem as long as it's controlled and as long as we're continuing to see this inflationary environment somewhere between that 2 and 3%. That's what we have to get to. But historically, what happens is this last 1%, 50 basis points of movement is the hardest. It's the most time consuming to get down to. So I think the fact that the economy and corporate fundamentals are so strong right now, it affords the Fed time to allow that to happen. It's a really good scenario, at least given all the context. And we've seen the market and equity market rally because of it, which at the end of the day has seemed warranted given the backdrop. It's not cheap. Markets are expensive in many ways, but this is the reason why, right? Because a lot of things are going pretty right from an economic standpoint on inflation. Unemployment came back down to about 3.8%. The labor market's really tight and doing really well. When we start to flip to equities, I think that the name of the game over the last really 15, 16 months has been what's working. I don't think people have appreciated for the first 10 months of 2023 how much of the return was driven by what we call the Magnificent Seven stocks, right? These are the big tech names you know: Alphabet, Apple, Amazon, Meta, and Microsoft, and then NVIDIA and Tesla, right? Those are the Magnificent Seven stocks. And you can see when you look at the returns from the end of 21 through around the end of February, of this year, how much of it was driven by some of these big technology names. And here's the key. It's not just because of, I think I've seen references to the year 2000 of things are expensive. They're not cheap, but they're not drastically expensive. You know, they're a little bit expensive. Here's been the reason why NVIDIA's taken off. NVIDIA hasn't taken off because all of a sudden, you know, everybody's paying more and more and more from a price to earnings ratio, right? And earnings haven't moved. Look at the green bar. Their earnings per share has just exploded on the back of what's happened in artificial intelligence. Amazon, Microsoft, Meta, you've seen growth in earnings being the primary driver. Over the long period of time, earnings drive market movements. It's not because people are willing to pay more, that's more short term. In the end, over the long term, markets will move as earnings move. And we've seen earnings largely driven by these 7 names being able to drive equity market performance. So when you look over the last year and this year, what's working, you know, this year it started to branch out, but for the first 10 months of 2023, these 7 names are primarily what worked. They drove a vast majority. If you remove these 7 names from the S&P 500 or any market index, returns were pretty flat for the first 10 months. The last 2 months of the year, the beginning of this year, we've seen it widen out a little bit where you're starting to see not just big tech work, you're starting to see financials, industrials start to have some movements in their stock prices. So broadening out is a really good thing from a market standpoint because it shows a healthy market rather than a very concentrated, overly reliant market. And we've seen this over the course, like I said, of the last even really 6 months. So if you look at this graphic, this is the S&P 500 cap weighted versus equal weighted. So cap weighted is market cap weighted. That is when big tech is, you know, the top 10 names of the index are about 30%. That's called cap weighted. Whereas equal weighted says we're going to take all 500 names and weight them equally, as the name implies. So as the market breadth widens out, equal weight starts to outperform cap weighted. And you can see really since the end of 2022, there was this long run up in 2023 where cap weighted dominated, right? The top 7 names had just performed so much better than everybody else. But over the course of the last couple of months, what we saw was this reversal where things started to widen out. Now is this the drop towards the end of 2023 where we started to see more names start to perform well, earnings start to come into line. You're starting to see a lot more broadening out, the breadth widening within equity markets. That is a healthy part of the market. If things were too concentrated for too long, you become overly reliant on a single name. What I like to really put in perspective, and I did this in my newsletter, was, you know, it's a great timing for March Madness. I love March Madness. The NCAA tournament is one of the coolest times of the year for people who enjoy sports. And the way I was trying to explain it to people, and members of my team actually brought this to me, and it was a great perspective of if the Magnificent 7 stocks, or even just the top 10 stocks, just use that in the S&P 500, are what we would call 1 seed in the NCAA tournament. Who are the Cinderellas, right? What are the asset classes that can make a deep run and just outperform the market as we look forward? And I want to, like, you can get into the minutia of this, that, why pick a stock or pick an asset class. I think it's just important to rethink what else is out there, because you become too fixated on those top 7 to 10 names. Quietly, small cap is starting to show some signs of some strength. So in this graphic, what this is the S&P 600 versus the 500. So this is the small cap names versus the large cap names. What it is year over year change in quarterly earnings. What you see is that earnings in the red line, which is the S&P 500 US large cap, has been much stronger, especially in 2023, than small cap names. But we're seeing that reversal, right? And performance, a lot of times over the long term, will be driven by earnings. And you're starting to see earnings growth really tick up in the small cap space. You're starting to see small companies do well, which, you know, there was concerns over higher rates and inflation. And, you know, there's different parts of the small cap market where it's just less tech, it's more industrials. It's a different type of makeup, but you're seeing earnings start to tick up, which is a great sign where you can start to broaden out, where we not only do look at the other names in the S&P 500 for US large cap, US small cap as now another area of opportunity as we look forward. So I would look at small cap as an area of, if we call it a Cinderella, you know, an asset class that's not getting a whole lot of love right now. this is an area we do start to see some strength. It might be an area of opportunity moving forward. In fixed income, I think there's a couple things that are important to keep in mind. So these are the different asset classes on the left-hand side, treasuries, then you can go into corporates and high yield. And there's two bars I think are important to remember. One is on the right-hand side is the 2024 year-to-date return. So you can see largely it's red. It's mostly negative, as we discussed, with yields rising on concerns of, and it's not really a concern, it's the market coming into balance with what the Fed's telling them. But on the left-hand side, I think that's an important part of, as we look forward, what matters. If you recall, at the end of 2021, those yields were much, much lower. But now you look at the US aggregate yield back in March, nearly 5%. The best predictor, or one of the best predictors of your future return in fixed income, is your current yield. And I think investors should be comfortable knowing that bonds should be bonds again. It's not 2022 where you're facing higher rates and this massive headwind. Now you're at a point where rates have largely peaked. We expect them to have peaked, and you have a better starting place in yields. We're not saying you should be expecting double-digit returns in bonds, but your future-looking returns in that mid-ish single-digit rate of return over the course of time on an annual basis seems much more relevant, seems much more reasonable, barring anything drastic changing in either direction, right? But yields are attractive across fixed income, which is a great place to start. You see default rates pretty low. Once again, it's another good sign from a fundamental look at corporations. Default rates stay pretty low. How are we looking at portfolios? Always like to kind of end in this area. So what we're seeing is, portfolios overweight US over international. This is a position we've had for quite some time. We've seen a strong US dollar. We think a strong US dollar will continue to favor domestic equities. So we have overweighted US over international. We see earnings stronger, growth stronger in the US space. So that's something that we're looking at doing in our portfolios, is continuing to overweight US equities. We have a little bit of a hedged equity and position just to offer us some what we call convexity, right? Some downside protection with upside potential. That's something we can do with using options in our portfolios. But some of the tactical allocations we have, semiconductors, right? Chip stocks, something we've owned for a while. Communication services sector, which is an area that we see opportunity with Alphabet and Meta. And then in fixed income, we've been focused in the core space. You saw those yields where the aggregate index is somewhere around 5% yield. You can get nice yield without taking a ton of credit risk, right? And you don't have to dip down to high yield where you may yield a little bit closer to 7-8%, but you're taking on much more credit risk and not much more compensation for the extra default risk that you do take. So largely, we haven't had to make a ton of changes in our portfolio over the course of the last 6 months. We've just been tweaking things on the fringes because US over international has been a trade that we continue to like. We like the semiconductor position. We like the communication services sector right now. We do own dividend-focused equities, which is an area that we think moving forward, those higher quality names will continue to pay off from an income perspective. So I think I'm at 25 minutes or so. I'll kind of take a pause. Andrew, what questions do you have? What do you think?
Yeah, we have one or two. Thank you, Mike, as always. Very insightful. I love the NCAA bracket, which, by the way, run a pool, legal pool, I guess. And after 30 plus years, I finally placed. I got second. I'm really excited about it. It's the first time ever. Even my brother won when he picked in the bathtub when he was in third grade. But anyways, to that end, I do have two questions here, and anyone else that has them, feel free to just type them in. I'll field them accordingly. The first is on Bitcoin, right? Everyone's the craziest asset class. No one really understands it, but what we do know is that Bitcoin, over the past month or two, became eligible to be an ETF. So what does this mean for the asset class or investors, and what are your thoughts?
Yeah, it's a good question. So going from what was being held in a Coinbase account in a much more inaccessible way to access crypto, the fact that Bitcoin was now launching an ETF, it created liquidity opportunities. it started to democratize the asset class, which is a good thing. We want democratize as long as things are overseen and regulated. Democratization is great for the industry to make things more available at a reasonable cost to more and more investors. Look, for us, our stance on it hasn't changed. To us, it's still an asset class that can go from 20,000 to 75,000, back down to 20,000, back up to 75,000 in the course of 2 years. Massive swings, massive volatilities, and it's still finding its place in markets. Because I think you have to ask yourself a question of what you're trying to accomplish with it. Are you trying, Bitcoin is often described as a digital gold. Well, gold doesn't do that. Gold doesn't move like that. What you look at and see is that most of the crypto world has been kind of this high beta tech relationship. So if you look at the NASDAQ and Bitcoin, it kind of does the same thing. Not perfectly, but it largely does the same thing. It's been more of a risk asset, more speculative. And we still see that, for our investors. And look, you can have a position of belief in crypto, of a long-term place in the marketplace, long-term opportunity for my portfolio. I'm willing to speculate on it. We'll talk with our clients and we'll find a place. It's usually a small piece of their portfolio. Across the board, though, it's not something that we are going ahead and including in our portfolios as a core piece yet. There's just too many unknowns. There's too much volatility. And candidly, if we can't sit here and tell you, like on one hand, if there's it's a gold replication, and then on the other side, it's a high risk technology allocation. Those are very different use cases. So for us, if there's not clarity there, we're happy to educate our clients on the opportunity, what ETFs are available to them, how we can buy it for them if they so choose, where it should fit in their portfolio if they're interested in it. But it's certainly not something that we're doing across the board. I just think it's just another case of investors making sure that they're comfortable with that allocation, what it means, and what the opportunity set is.
Awesome. Okay, rapid fire questions for you here. I got a couple coming in hot off the wire. So two I'll conflate together because they're in the same world, which is what do you think what impact of the unprecedented level of U.S. federal debt and spending on earnings and on the Fed's actions will be? And I guess second question that came in very similar is how can inflation ever subside as long as the Fed keeps printing money?
Yeah. I think the last question first is I don't think the Fed can continue to print money the way it has. I think that's pretty clear. I do agree that I think there's a couple components here, because if you look at monetary policy for just even use the year 2000 through 2020, we had a pretty accommodative monetary policy and money was printed and there was virtually zero inflation, right? It was below trend. It bucked what most people would theoretically believe, right? What economic theory would tell you. But what you saw was that pent up, that the money supply increasing at the rate it did, plus pent up demand just unleashed a whole bunch of demand into the market. Lack of supply given what happened with COVID. It was just this confluence of events. But it doesn't mean that inflation is going to go away, right? I think we may have to be comfortable with 2, 3, 4% inflation at times, and ideally keeping it stable at that 2.5-ish percent range. But when you go to the conversation around the U.S. debt, it is one of those things, just like Social Security, that will need to be addressed. We have not balanced the budget since the 90s. That's just not happened. So I know people turn it into a political conversation. It has not happened since the 90s, and at some point we cannot continue to raise our debt. There's interesting studies. Wharton does a really good one about what the sustainable level is for U.S. debt. And there's a level that they believe, which is about 160, 170% of GDP, I believe it is, where things start to become untenable. And then we're around 100% of GDP from a federal debt perspective. So that has to be brought under control. I think one of the ramifications for that, well, I'll say two of them, right? One being that, government spending may have to get cut, right? Or taxes will have to increase. both of which are headwinds to economic. If you look at the composition of GDP growth, right, consumer spending, higher taxes will drop that. On the other side, if government spending's dropped, government spending is a line item of economic growth that will get hit. So I do think there is an element of we will have to rectify running continuous deficits and piling up debt above our GDP because there is an unsustainable level. Second, I do think that the natural ramification will be that when the Fed goes to issue, especially 5, 10, 30-year debt, that you're going to see those premiums increase, meaning that the yields that investors get are going to be higher in the 5, 10, like they're going to have to have higher debt costs over the course of time because investors like me, you are going to require higher returns even though it's a safe asset, it is backed by the full faith of the US government. It doesn't mean that it is, investors aren't going to require higher returns given the perceived higher risk. So I think interest rates, especially on the longer end of the curve, when you look, people focus on the short term, which is driven by the Fed, but the longer end is going to get driven by what all these different components. Higher inflation is going to push that up, right? Where investors are going to require higher yields as things go out. So there's multiple ramifications. I think you can, some investors will take an apocalyptic view of different things. Look, there's a lot of different tentacles and it's a complicated question, but I do think some of these little pieces are going to have to, just like Social Security, at some point it has to be rectified. And there's a few options. It's just none of which are politically very attractive for anybody to run on.
Awesome. Last question that I have here is, what is your opinion on keeping a large position of gold, silver, other commodities at this time or at any time, I suppose?
Yeah, I don't love it. I think that's the short answer. I think gold over the long term has just proven to be just not a good asset class, for long-term investors. I think your expected rate of return in something like gold is really inflation. So even if you said, hey, look, long-term inflation is going to be 3%, I'm not betting on your gold rate of return being more than 3% over the course of time. And you've seen it over and over again that I think even if you did the real return, so if you did the return of different asset classes after inflation, I think gold is virtually flat. You look at equities have done really, really well. And I think equities will benefit from a higher inflationary environment as long as it's kept within reason, right? If inflation is 3% over the course of time, I do think inflation will be beneficial to corporate earnings as long as it's kept within reason. I think large portions of your portfolio to gold are just kind of a very pessimistic view on the US dollar, on so many different parts of both the global economy and markets that I think you're going to run into too many headwinds. And I would suggest if you have precious metals or something like gold that is kept within reason within your portfolio, right? Because I think the drawdowns and the opportunity cost of doing so, it's just too high.
Awesome. Mike, I think that rounds us out for questions and great details on what we've seen, what to expect. And what I love about all your talks is the perspective, right? I think so often we get bipolar on our decisions and we start hopping from one to the next and we're not sure what to glob onto, and we see a lot of news out there and we panic or we get too excited about things. And you really have a nice job of keeping us even keel and sort of the eye on the prize, which is to have all our goals accomplished. So we will share this around. Please share with anyone you think would benefit. Mike, thank you so much. And thank you all for your trust and friendship and business. We certainly don't take it for granted. So thank you. Everyone have a great day. And summer is in the air. It's coming. I feel it. So take care, everyone.
Take care.
All right.